Without question, the curse of Nixon and his 1971 suspension of the gold exchange standard, together with the subsequent failure to repeg the dollar to gold, is one that continues to haunt our economies to this day. And just this week we have seen this extraordinary chart released, which highlights household net worth to net disposable income at record levels. Today we explore the consequences of Nixon's curse, so let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. So let's now look at this chart again. Household net worth to net disposable income has absolutely soared, way above the average of 540%. So let's think about what is actually taking place here. As consumer price inflation has risen and wages have failed to actually keep up in real terms, it reduces household net disposable income. This reduces the denominator in this calculation. At the same time as house prices and stocks have risen substantially, it has resulted in the numerator accelerating in value. Consequently, we see this relationship hitting new highs. But it's worth also pointing out what happened following the 2008 financial crisis, where we saw a plunge in the value from a then all-time high of around 650%. Thereafter, real estate and stock market values collapsed and we returned to the mean. Now, today's number is so ridiculous, it's almost 50% higher than the long-term average of 540%. More importantly, it means that the total net worth number, which in quarter two hit a record high of $142 trillion, is massively inflated on the back of what is obviously the biggest asset bubble on record. This is Nixon's curse. For the abandonment of the gold peg and the subsequent deregulation and liberalization of financial markets in the 1980s allowed the creation of vast swathes of credit or debt, which has had a colossal impact upon both consumer price inflation and asset market inflation. For the new system encouraged massive proliferation of leverage and financialization, which led to enormous consumption, most notably in the US and the UK, much to the benefit of other producer economies like Germany and, of course, China. Surplus countries then refunneled their savings back into the West, keeping rates low and driving consumption ever higher. But this process, together with excess bank credit going towards asset markets, was found out badly in 2008. But that has certainly not stopped the debt binge going ever higher. Indeed, this table highlights the global debt burden, which in numerical and as in percentage of GDP terms continued to rise right into our current crisis, which has now seen many of these same debts balloon. Yet this table itself greatly understates the true level of global financialization, which various bodies, including the BIS, McKinsey, and the World Bank estimate as being anywhere between $400 and $800 trillion of unstable financial instruments, derivatives if you like. So the real level of financialization could be anywhere between 4 and 10 times global GDP. Absolutely staggering. And in this fascinating article, Dominic Frisby points out how credit has played a significant role in driving certain prices up but not others. In considering price rises from 1970 to present day, he considers how an £882 Ford Cortina in 1970 has seen a price rise of 32 times to £28,500 for a current day Ford Mondeo. Meanwhile, an average home has risen from just over £4,000 in 1970 to a 65 times increase of just over £265,000. Compare the price increases of these heavily leveraged products to a 20 times increase in the average salary or a mere 9 times increase in the price of a pint of milk. Yet white goods, rarely purchased with leverage and subject to enormous productivity gains as well as globalization, have increased in price just 4 times. If we take the example here of washing machines as he gives. And thus it is no surprise that those who can access the cheapest capital and generate the most leverage are those using the current crisis to their advantage. The effective Fed put on stock markets, where participants know that central banks will have to respond to any fall in asset markets, has made the risk-on trade the easiest one to play, much to gold's detriment, of course. And it is therefore no surprise that the temptation of trading stocks has been just too great for some Fed presidents, as reported here. And in addition, we can see just how lucrative the last 18 months or so have been for the top 1%. Yet the crucial point here is that financialization has caused such enormous excesses in asset values that it cannot realistically be unwound. If it were, we would see a colossal collapse in prices, one that just would not be accepted by most of the Western world. The impacts would be so incredibly profound. Government tax revenues would crater, consumption would plummet, and the banking system would collapse, as many households would be left in negative equity in the mother of all deflationary collapses. While we could well see such a situation take place, and it does certainly seem highly plausible, the reaction of central banks and their cronies, and here I'm thinking about the likes of BlackRock, the so-called fourth arm of government, would be quickly intervening to buy up vast swathes of the asset base. Thus, central banks would intervene to an even greater length than they did so back in the spring of 2020. And while the cost of this policy and necessary transfer payments would be galloping inflation, it would be small price to pay in maintaining the global takeover that is underway. And in this wonderful quote from Macquarie's Victor Chevets states that the need for perpetual growth, funded and supported by financialization and debt, is the opiate of the people and the soul of the soulless culture. But despite the stellar performance of risk assets recently and the desire to keep the melt-up going, maintaining a holding of physical metals seems sensible if we consider what the great economist Ludwig von Mises called the flight into real values. That is the frantic rush to convert paper monetary savings into buying goods and commodities, whether needed or not, to avoid holding depreciating monetary units. Indeed, we are already beginning to see this right now. Nixon's curse lives on. Thanks so much for watching. Do consider subscribing, and I look forward to seeing you next time. Bye bye.